Guys, thanks for coming out today. I'm going to talk a little bit about insurance. The agenda is we're definitely going to cover life insurance. We're going to cover long-term care insurance. If we have time at the end, I'd like to talk a little bit about disability insurance as well. Disability insurance is something, in my opinion, that a lot of times flies under the radar when people are making insurance purchasing decisions. So, my name is Patrick Lach. I'm an associate professor of finance here at Eastern Illinois University. And I wear another hat as well. I'm also an investment advisor representative with Lach Financial. It's a fee-only registered investment advisor based, headquartered in Louisville, Kentucky. So in light of that, disclaimer, things I'm going to talk about, it's not investment advice. It's not an offer or recommendation to buy or sell an investment product. All investment decisions carry risk, including the risk of financial loss, and it's a responsibility of the individual to consult with a financial or tax advisor. Now that that's out of the way. Everybody approaches situations with their own biases. And I'm going to start this presentation acknowledging my own bias. And also to provide a little bit of an overview about insurance. So, how does insurance work? What are we doing with insurance? In the most basic theoretical sense, we are risk pooling. So, we have a risk that we don't feel comfortable taking on our own, so we get a bunch of people together, and rather than one person taking a huge hit if something bad happens, by pooling people together and having everybody pay a little bit, we could create this pool of money so that if anybody that's paying into this pool has a loss, we could use that pool of money to mitigate the adverse financial effect of that loss. Here's where I guess I'm going to sound a little bit cynical. How does insurance work? Well, insurance companies pay actuaries a whole bunch of money to run some numbers to make sure that the insurance company is going to make more from the policyholders than the insurance company will pay out to the policyholders. That's how insurance works. By the way, there's only one other industry that does this. There's only one other industry that pays statisticians large amounts of money to make sure the company will make more on the customers than the customers make from the company. Any idea what that other industry is?
Sports.
Not sports. You want to take a stab at it? Gambling. Gambling and insurance are the only two businesses where actuaries and statisticians are paid very well to ensure that the house has the advantage. So, because of that, in finance, we have this thing called net present value, which basically says with any investments, we'll have cash flows and they're spread out all over the place. Net present value is a way to get all those cash flows on a level playing field where we could evaluate if we have a positive investment or not. So in finance, we say a positive NPV investment is one that is profitable. It's going to create wealth. A negative NPV investment is going to destroy wealth on average. And insurance, any insurance policy is a negative NPV investment. On average, you will lose. That's how the insurance industry works. Go into almost any major city in the United States, find the tallest building, it's probably owned by an insurance company. Right? They're not in the business of losing money or making bad bets. So, you pay premiums when you buy any type of insurance, whether it's life insurance, long-term care insurance, auto insurance, renter's insurance, whatever the case may be, you pay premiums. And those premiums, the insurance company will collect them, and if they don't need to pay them out, they're going to invest those premiums and earn a return on them. That's another way insurance companies make money. So, because insurance is a negative NPV investment, because on average the insurance company will make more from you than you make from them, because of all those things, the way is, an academic, the way I approach insurance is, for me, insurance is a last resort, not a first option. And that's one of the issues I have with a lot of people that work in the financial industry or the insurance industry, because for a lot of these people, insurance is the first option. If we have any risk, let's get insurance and take care of it. So stepping back a little more theory behind insurance before we dive right into some actual examples and pros and cons of different insurance policies. Insurance, the academics say, is a form of risk management. And there's several ways, there's 4 primary ways we can manage risk. We could just avoid it, right? There's some people that are terrified of airplanes because they say it could crash and I don't want it to crash, so I'm not going to fly, right? That is one option. I also own a couple pieces of investment real estate, and there's a lot of real estate investors that will avoid any house that has a pool because they say it's a whole can of worms, it's a ton of liability. A lot of real estate investors will say, I don't want to deal with that, so I will not buy any house that has a pool. That's avoiding risk. We could also reduce our risk. For example, if we have a car, we could not drive the car as much. Trying to think of some other good examples of reducing risk. But one would be just not driving a car as much, or taking steps to ensure that something bad won't happen. So if we have a car, we'll buy a car with airbags. There's so many new high-tech features that are out right now that we could have those features on the car, and that will reduce the risk that we'll be in a crash. We could also just accept it. When I first started teaching here at Eastern, it was 2008. It was when gas was at $4.50 a gallon. I was driving a pickup truck, so I bought a used Honda Civic. And it was about 10 years old when I got it. And the car wasn't worth much. It had a ton of miles on it even when I got it. And so my philosophy was, it's a cheap car, it's only a couple $1,000s. I could accept the risk of, if anything happens to that car, I could afford to pay for it. So I'll accept that risk. So there's some risks that we accept, right? To enjoy the convenience of traveling by car, we have to accept the risk that we're going to be in an accident. The fourth option, this is where insurance comes in. We could share risk. So if it's a risk, we're afraid that our house could burn down. And the odds of that are really small, but the cost is really high. So the solution is, let's get some other people together that have a similar fear, and let's all pool our risk. Let's all pay a little bit, put it into a pot, put the money into a pot, and if any of us have our house burned to the ground, we'll use the money from that pot to repair, replace, or rebuild. Right? So in theory, that's how we handle risk. We could avoid it altogether, we could reduce it, we could accept it, or we could share it. For example, we're going to talk about life insurance. And the reason for life insurance is if you think there's anybody in your life that would be adversely impacted financially, hopefully people will be adversely impacted emotionally when you die, but if there's anybody that would be adversely impacted financially with your death, then you need life insurance. So, with the need for life insurance, one way to avoid that is to be a curmudgeon. Push everybody out of your life so that nobody needs you financially. Of course, we could reduce that risk by living a healthy lifestyle and reducing the risk that we'll die early. Or we could just accept it and say, hey, look, it's a risk. It's something that could happen. And if it does happen, then my loved ones will have to deal with it. So the fourth option is share that risk. Right? We could pool with lots of people. That way, if any of the people in the pool die young, we could use money in that pool to give to that individual's loved ones so that those individuals wouldn't be adversely impacted. So, what does it do? Life insurance, it's a policy, and if you die by a certain time, it will pay your beneficiaries, whoever you name in the policy, it will pay them a fixed amount of money. What's nice about life insurance The IRS typically wants their money on one end of the equation or the other. They want their money up front or they want their money in the end. With life insurance, what's nice about it is, as an individual, when you buy a policy, you purchase that policy with after-tax dollars. In other words, what you're putting into this insurance policy, those dollars have already been taxed. Therefore, when you die and that insurance company pays a set amount to your beneficiaries, the money your beneficiaries receive is not taxed, because the money you use to share longevity risk, or I guess it's mortality risk, the money you use to share that risk, it's already been taxed. The IRS already got their share. And by the way, that's really, really convenient, because we're going to talk in a minute about how much life insurance you need. And the reason that's a really handy feature is because if those proceeds were taxed, not only would you have to estimate how much life insurance you need, you would have to sort of back into that amount by estimating what the tax rate's going to be for the beneficiaries. And man, if you look over the last 80 years in the United States, tax rates have been all over the map. So that would be very difficult to try and pinpoint. So what does it do? It's a policy. We pay premiums every month, and that policy will pay beneficiaries a set amount. Here at Eastern Illinois, employees, the university pays for a policy for us. And I believe our policy here is equal to 1 times our annual salary. So that's one of the benefits that the university provides to employees. So the reason it's needed, as I mentioned a minute ago, it's needed only if there are people in your life that would be adversely impacted financially by your death. It's the only time you need it. When I first started teaching here, was single, straight out of grad school, there was nobody financially dependent on me. I didn't need life insurance, but the university provided a policy for me anyway, but I didn't need that policy. So I'm now engaged. I'll be getting married this summer, and that's a conversation my fiance and I will have is will I need life insurance, or will she need life insurance? Starting out, honestly, neither one of us will probably carry life insurance beyond what I have here through Eastern. Once a kid comes along, then yes, I'll probably be shopping around for a life insurance policy, because kids are expensive, and if I died, would my fiance be able to afford the cost of raising a kid as a single mother? So that's what insurance does. That's when it's needed. Now, your need for life insurance over time, I'm going to talk about some different types, but over time, your need for life insurance should go down. So again, using myself as an example, once a kid comes along, my fiance and I will probably be buying life insurance. But what I'm probably going to do is, I'll need to talk to my insurance agent about it, but what I'll probably do is stagger those policies. So I might buy one policy with a 20-year period, and then another with a 15, another with a 10, and another with a 5. So that every 5 years, the amount of insurance I have will decrease. And why am I going to do that? Well, the reason I'm going to do that is because over time, the wealth of me and my fiance hopefully will be increasing. So every year, there should be less and less and less of a need for life insurance. Every year, our mortgage balance is going to get lower and lower. Every year, student loans are slowly going to be chipped away. Every year, retirement savings will increase. So over time, if you're doing what you should be doing, your need for life insurance will slowly be reduced. Now, we have different types of life insurance. The most basic type is called term life insurance. Term life insurance, very simple, very basic. You contact your insurance agent and you say, I'll use myself as an example. Let's say I decide to get $250,000 of life insurance, and I want to get 20-year term insurance. I'd call my insurance agent, and I'd tell them that's what I wanted, and they would give me a quote. And whatever that quote would be, if I decided to get that insurance, I would pay that amount every month to my insurance company. And I would continue to pay that every month for the next 20 years. So I'd make 240 payments to the insurance company. If at any point between when I get the policy and 20 years later, if at any point I died, that policy, that term life insurance policy, would pay the beneficiaries I list $250,000. And of course, the beneficiaries would receive that tax-free. There are lots of other types of life insurance. One example is whole life insurance. And with whole life insurance, the premiums, first of all, the premiums are a lot more. And they're higher by a magnitude, usually higher by a magnitude of about 7 or so, 6 or 7. But the premiums are significantly higher. But with whole life insurance, the policy's in place for life. And there's all sorts of other types. There's universal life insurance. There's all sorts of other policies. We won't, I'm not going to dig too deeply into that just because the only type of insurance that I would use and the only type I recommend for my clients is term life insurance. The reason for that being, some people might disagree and say, well, the problem with term life insurance is it could expire and you could still need the coverage. But again, for most people, your need for life insurance will decrease over time. All right, so 20 years from now, I imagine the mortgage will be paid down pretty low. Our debts will be minimal if they're existent at all. Hopefully we'll be debt-free except the mortgage in 20 years, maybe even debt-free with the mortgage in 20 years. So if we had no debt, we had no mortgage, and our kids were grown and financially independent, there's no need for life insurance. So that's why I only use and recommend term life insurance. Again, other people would disagree and say, well, you need that permanent coverage over time because you never know what's going to happen. And then there's also agents that recommend the variable policies. Sometimes people say, how come you don't recommend, these other universal life insurance or whole life insurance? And the reason is, frankly, I've never met anybody that recommends those products that is not paid directly or indirectly to do so. And until that changes, to me, term is the way to go. So it's important that you recognize incentives when you're shopping for any financial product. So I'm going to give another presentation here in a little bit about investments, and it's even more crucial when it comes to investments. But when it comes to insurance, you need to recognize the incentives of the person selling you insurance. They're typically paid on commission. They typically get a percentage of any premiums. Therefore, naturally, they have an incentive to recommend the policy that's 7 times more expensive because they'll get 7 times the commission. So John Bogle has a great quote. I believe it's attributed to John Bogle. The quote is basically, you can't expect somebody to understand something when they're paid a small fortune not to. And that's my take on really any type of life insurance except for basic, plain vanilla term life insurance. I always tell my clients, remember, insurance is it's a losing proposition long term, right? Insurance companies make sure the odds are in their favor. So with any type of investment that's going to be a losing investment, you should minimize the amount of money you're putting into that investment. So that's my take on whole life insurance and all the other variations of the permanent life insurance. And that's why I only stick with term. So how much should you have? again, in my opinion, everything comes back to theory. Why do we have this insurance in the first place? We have it to mitigate any adverse financial effects of our death that our death will have on loved ones in our life. So the issue is, well, how much would it take to mitigate the effects of dying? And basically, it comes down to a lot of factors, and this is something where it's unique for everybody, and this is where it really makes sense to sit down with a financial professional to go through and really evaluate, all right, what are the incomes coming in, and what would be the impact of losing spouse A's income, what would be the impact of losing spouse B's income. Again, I would go with an independent, objective financial professional. I wouldn't ask an insurance agent because they're going to be incentivized to give you a little bit, I don't want to say overstate the number, but they're going to err on the side of selling you more life insurance than less. Right? So again, incentives matter. So in looking at the needs, you need to figure out, okay, what is the income that each spouse is contributing, and how much money would we need to offset the loss of that spouse's income? So, for example, if one spouse, after taxes and retirement savings and everything else, if that one spouse is bringing a net $1,500 after taxes to the family, and that family has a mortgage payment of $1,500, and the mortgage balance is $200,000, well, if you didn't have that $200,000 mortgage, the death of the spouse bringing $1,500 into the family would be offset. All right, so that's a very basic example. There's obviously a lot more moving parts when you look at this in practice, but that's the way I approach it, is what would it take to offset the income that the higher paid spouse is bringing into the relationship. So another thing is, what if retirement was fully funded? So if you have spouse A and spouse B, if spouse B died, what if spouse A didn't have to save for retirement anymore? So those are all factors in figuring out how much life insurance you need. So it's something that would be very hard for me to do justice in a short presentation, but this is something where it makes sense to sit down with a financial professional and assess what those needs are. But a very kind of back of the envelope approach is figure out the after tax and after savings incomes of each spouse, and figure out, are there any sort of debts that we could eliminate that would eliminate the need for that second income? So to me, that's a very easy and basic way to approach life insurance. Long-term care insurance. So we'll talk about this briefly. When I was asked to present about long-term care insurance, my initial response was, well, I'm not really going to have much to say because honestly, I don't recommend long-term care insurance to my clients. We'll talk more in a minute, but in my opinion, the risk of having it is almost as bad as the risk of not having it. So we'll talk a little more in a minute. So what does it do? Long-term care insurance is if you need to go into a long-term care facility, and the needs are typically based on what are called ADLs, activities of daily living. You know, can you dress yourself? Can you prepare your own meals? Can you feed yourself, etc.? If you can't do a certain number of those activities of daily living, then you're going to need assisted care. And a long-term care insurance policy will usually pay you a set amount. It'll give you a set amount per day to use towards long-term care. So at its core, that's what long-term care insurance does. So why is it needed? Well, it's needed because some people are going to have to go into a long-term care facility before they die. Women tend to outlive men. So if you have a household where it's a man and a woman, the man might not have the need for it because typically women outlive men by about 5 to 6 years. So as the man gets older and the woman is going to outlive the man by 5 or 6 years, the woman could take care of the man as the man ages, but once the man passes away and the woman survives, then there's, in some cases, there will be nobody there to take care of the surviving female spouse. So a woman, the average is 5 years, 6 years. It could be a lot longer than that. Again, a personal example, my grandma passed away before I was, or my grandfather passed away before I was born. My grandmother passed away when I was 29. So that's 30 years as a widow. So this is important, especially for female clients. So what are the risks of not having it? Well, if you don't have it and you have to go into a nursing home, it could deplete your retirement savings in a hurry. National average for a full assisted living facility, $77,000 a year. Of course, the costs are lower if you just have somebody coming to the house, for a couple hours every day to help with meals, etc. But worst case scenario, if you're in a nursing home facility, national average is $77,000 a year. That varies state to state. I think in Massachusetts the average is $100,000 or $110,000. But these facilities can be pretty expensive. So that's the risk of not having it. My attitude when it comes to long-term care is you could spend money on this policy, but what's been happening, and I'll get into this on the next slide, what's been happening is long-term care insurance is very new by insurance standards. Life insurance been around for a long time. Homeowners insurance been around for a long time. It's old hat for the insurance companies. They know what the risks are. They know how to price it. Long-term care insurance is only about 40 years old, give or take, maybe a little bit less. And so life insurance companies are still figuring out this whole market. And the problem, to me, a big part of the problem with long-term care insurance is they've done a fairly lousy job of estimating the risks of these policies. And what's happened the last 3 years is the insurance companies realize, oh man, people are living longer than we thought. These facilities are more expensive than we thought. They're thinking, man, we really screwed up when we price these things. We're going to need more money in premiums for this to make sense. So what's been happening the last 3-4 years, insurance companies have been raising these premiums drastically. And when I'm talking drastic, I'm talking 40, 50, 60% premium increases. So to me, that's the big risk of having it is, man, I can't think of anything worse than having a long-term care insurance policy for a decade, paying $2,000, $3,000 into it year after year after year for 10 years, and then get a notice that your premiums are going up so much that you can't afford them, and you have to cancel the policy. So that's something that's been happening. There is some recent research from, I believe it's out of Boston, it's Center for Retirement Research, I believe, CRR. And they have documented a pretty high lapse rate. Now, defenders of long-term care insurance have stepped in. They've said the data used in that study is dated. If you look at more recent data, the lapse rates aren't as high, but that's one risk. And so to me, when I say my attitude is rather than long-term care insurance, let's take what we had put into a premium and let's invest it and earn a return. And some people say, yeah, but rates are terrible and markets haven't been generating a return. But I remind them, when you buy insurance, you and your insurance company are fishing from the same pond. What that means is if the rates you're earning on your investments is low, they're earning that same low rate. And if they continue to earn that same low rate, there's going to be a premium increase coming. So I always remind people of that when it comes to long-term care insurance. And that's where I think everything comes down to theory. You have to understand at the heart what's going on with insurance. You're paying money for premiums. The insurance company is increasing those or investing those premiums until it comes time to pay out claims. And if they're getting low returns and the amount being paid out for claims is staying the same, and that pot gets low, they're going to ask for a premium increase. So, some final thoughts. When it comes to long-term care insurance, this holds true for life insurance or any type of insurance. A lot of these policies will have all sorts of fancy bells and whistles that make the policy more attractive. What I always remind people is anytime your insurance company offers you something, keep in mind that offer is designed to benefit them, not you. They're going to make more money off of you than you make off of them. They pay actuaries a lot of money to make sure that happens. So, especially with life insurance, there's all sorts of fancy bells and whistles you could get. Remember, that's designed to increase profit margins. And I have life insurance up here. This should say long-term care insurance. As I mentioned before, long-term care insurance is very new. Life insurance has been around for a while, so that's a typo. Long-term care insurance is still very new. Companies haven't figured out how to price it. And because of that, insurance companies are leaving the long-term care insurance market in droves. Genworth, which I don't know if they still do, at one point they controlled 35% of the long-term care insurance market. The CEO commented we would need 50% rate hikes just to break even. Again, this is an article from the New York Times where the CEO made that quote. So again, to me, that's the risk of having long-term care insurance, is you could pay tens of thousands of dollars into this policy, have the rates go up so much that you can't afford the policy anymore, and then you're stuck thinking, gosh, I wish I could go back 10 years ago, and instead of putting $3,000 a year into this long-term care policy, wish I just put that into an investment account and earned a little bit of a return. Then I'd at least have $30,000, which would be enough to pay for a little bit of my own long-term care. So, recommendations if you do have long-term care or if you do buy it and there's a big rate hike, a couple things you could do to keep the premiums affordable. You could reduce your daily benefit amount. Daily benefit amount will be anywhere between $250 a day to $350 a day. So if the benefit amount you select is $350 a day, if you scale that back to $250 a day, that's going to lower the amount that you're going to have to pay. It's kind of like with auto insurance, right? One way, if you want to reduce the premium on your auto policy, one strategy is to buy a cheaper car. Kind of the same way with long-term care insurance. One way to reduce your premiums is to not have such a large need for the premiums. In other words, reduce your daily benefit. That will reduce the amount the insurance company will have to pay you, and that will reduce your premiums. These policies also come with an inflation protection rider, because I think we've all heard, at least anecdotally, how much medical costs have increased and how much the care of long-term care facilities increase every single year. Some of these policies, you can get a 5% inflation rider on it, meaning if your benefit is $250 a day, next year it'll be 5% higher than that. And the next year it'll be 5% higher than the previous year. So another option would be to lower that inflation protection rider. Maybe instead of 5%, drop it down to 2% or 3%. So those are some of the ways that we could combat those rate hikes. I also want to talk a little bit about disability insurance. And this is something when a client comes into my office and I'm going through their financial plans, this is one thing that is almost always missing. And again, maybe it comes down to incentives. Maybe it's the fact that disability insurance is relatively expensive, therefore an agent's not going to get the big commissions. But for whatever reason, a lot of insurance agents aren't having this discussion with their clients. Mentioned at the very beginning, my bias is against insurance. It's a losing investment, therefore I want to minimize the amount that I pay into such a policy. However, with disability insurance, in my opinion, perfect candidate for risk pooling because it's something that is unlikely to happen, but the financial consequences are enormous. If you look and you found the present value of your future earnings capacity, if you're in your 20s, if you found the present value of your future earnings capacity, you're looking at a couple $1,000,000. That's a loss that should be insured, in my opinion. I have disability insurance here through Eastern, and I bought a supplemental policy as well because our disability insurance policy that the university pays for us is fairly minimal. So that's what disability insurance does. If you become disabled, it will pay you a set amount of money per month, and the payments usually end at retirement age, say 62 or 65. And there's usually a rider in there that says if you're close to that age, if you're close to 62 or 65, they'll give you a minimum of 5 years of benefits. So that's how disability insurance works. So for anybody who could not afford to lose their income, this to me is a no-brainer. Disability insurance, especially for a young person, this is an absolute no-brainer. One thing to keep in mind when you're evaluating disability insurance policies, first of all, a lot of people say, I don't need disability insurance. Social Security covers that. The problem is there are a lot of different definitions of disability. And there's 3 definitions. There's something called the own occupation definition of disability. That definition says you are disabled if you can't do the job you were doing when you became disabled. So the policy that Eastern Illinois University provides for employees, it actually uses a hybrid definition, but for the first 5 years of disability, it uses the own occupation definition. Meaning if something happened to me and I couldn't teach anymore, and the key phrase is material and substantial duties of your job. If I couldn't do the material and substantial duties of my job as a professor, I'd be able to collect disability. So for example, if something happened and my mouth was permanently wired shut, it's probably going to be hard for me to teach. And that's something where the disability insurance might pay for the premiums, or might pay, not premiums, but would pay me a benefit equal to a set percent of my salary. Right? So that's the own occupation definition. And so it's possible if something happened to me, my mouth was wired shut, so I can't really talk, but I could be a research analyst for, a Wall Street firm, whatever the case may be. I could still potentially collect from that disability insurance policy even though I'm doing another job. For instance, a classic example of this would be a surgeon of any type. If you're a surgeon, you need your hands. And there could be an instance where you hurt your hand permanently and you can't operate anymore, but you still have a tremendous amount of knowledge of whatever area of specialty it was, whether you're an arm surgeon, a heart surgeon, brain surgeon. Even if you can't operate anymore, you would have a deep understanding of the heart, the brain, whatever the case may be. So if you're a surgeon, you hurt your hands, but you could still work as a consultant or a research consultant, you could collect under that own occupation definition. The next tier down is the modified own occupation. That definition basically says you're disabled if you can't work any job for which you are reasonably suited based on education, training, and experience. So for the hand surgeon, if something happened to his or her hands and the surgeon couldn't operate, but they could work as a consultant, they could do research, they would not be considered disabled because there's a job that they could do for which they are reasonably fitted based on education, training, and experience. But if the surgeon was disabled in such a way where their only options would be very, very basic minimum wage type jobs, that would not be reasonably fitted, right? They wouldn't be reasonably suited for that because of their education level. So the final definition is the any occupation. So own occupation, you're disabled if you can't do your own job. Modified own says you're disabled if you can't do any job for which your training qualifies you to do. The any occupation says you're disabled if you can't work. So if you're a surgeon and your hands are broken or you have some sort of trauma where there's significant cognitive decline, but you could still work as a Walmart greeter, the any occupation definition would say you're not disabled. So, while Social Security disability probably won't protect you, Social Security uses the any occupation definition. So that's why I tell people it's important to have your own disability insurance. Now, the way disability insurance policies happen in practice is the own occupation definition, your premiums are going to be really expensive. So usually what will happen is the definition of disability will change during the policy. So for example, with my own disability insurance, the first 60 months of disability, the first 5 years, the definition is the own occupation definition. After 60 months of receiving payments from the policy, then the definition of disability goes to the modified own occupation. So in other words, if I was disabled and I couldn't teach anymore, that gives me 5 years to figure out what else I want to do with the rest of my career. Because after 5 years, if there's something else I could be doing, I'm not getting any more benefits. So those are some of the basics of disability insurance. I also tell people it's important to understand whether or not you're paying taxes on those premiums. Because, I'll give you guys another personal example for me here at Eastern. Eastern pays for a disability insurance policy for us. The downsides of it, it only covers half of our salary. So whatever you make, the university is only going to pay you half of that in benefits. The other downside is the university pays the premiums for the employees. To incentivize companies to do that, the government will let companies pay disability insurance premiums without, well, they'll let companies pay the premiums, but they allow the companies to write that off on their taxes. The employees also do not have to recognize those premiums as income. So said another way, the money that's going to my disability insurance policy is money that hasn't been taxed yet. Remember, the IRS wants their money on one end of the equation or the other. So the IRS is not getting their money from the premiums. Therefore, if I collected benefits, I would have to pay taxes on those benefits. So because of that, employees here at Eastern have the option to buy a supplemental disability insurance policy. And for anybody that works at Eastern, it's a no-brainer. It's really cheap and it increases your coverage up to 2/3 of your income. And the other downside of my policy here at Eastern, it only lasts 5 years, and then benefits end. The supplemental policy will cover me until I'm 65. The other nice thing about the supplemental policy, since I'm paying for it with my own money, with after-tax dollars, the benefits I get from that supplemental policy will be tax-free. So, I've been talking for quite a while. Does anybody have any questions about life insurance, long-term care, disability insurance? All right, well, thank you guys for coming, and I hope you enjoyed the presentation.